No hope for China's economic recovery. Foreign companies are closing or scaling back operations there. Despite the Chinese Communist Party government's stimulus plan to reverse the bleak economic situation, China's economy remains sluggish, leading the outside world to feel that hopes for economic recovery are slim. Major companies worldwide have started to cut prices and costs and scale back their business in China. Reuters reported on October 28th that major companies like Hermes, L'Oreal, Coca-Cola, United Airlines, Unilever, and Mercedes cited ongoing real estate crises and high youth unemployment in China as reasons for restrained consumer spending. Beijing outlined stimulus measures to support the economy in late September, but many of these measures lack detail, and their impact on consumer confidence is yet to be seen. China's business environment is challenging, and foreign companies are gradually adjusting their strategies there. Some have already started making adjustments. French carbon graphite manufacturer Mersen announced last week that it would close a factory in China, producing power transmission products because it cannot compete with local competitors. Meanwhile, international food companies such as Danone and Nestle have ramped up price cuts or are pushing online shopping options. On October 23rd, Coca-Cola CEO James Quincey said in an earnings call that China's operating environment remains challenging. The economy doesn't seem to be picking up, he told investors. Although the Chinese government has pledged additional support, the scope and timing of further stimulus remain uncertain, leaving investors unconvinced of the effectiveness of these measures. We used to have about 10 planes flying to China daily, but I think those days are gone forever, United Airlines CEO Scott Kirby told Reuters. United Airlines now has 3 flights daily from Los Angeles to Shanghai, and this is unlikely to change soon. It's a completely different world, Kirby added. Third-quarter earnings reveal China's economic downturn. As the third-quarter earnings season unfolds, the performance of major multinational companies further reflects that the Chinese market no longer provides the growth momentum it once did. Several executives have said that the business environment in China is troubled. The luxury goods industry is among the most affected by China's economic downturn. Economic uncertainty has dampened spending by middle-class Chinese consumers, and even the wealthy are now reluctant to spend. Luxury giant LVMH reported earnings last week that fell short of expectations. The company noted that Chinese consumer confidence is at its lowest since the pandemic, with demand for fashion items deteriorating over the quarter. Another luxury leader, Kering, also warned last week that annual profits could drop to their lowest since 2016 due to weak demand from China impacting its flagship brand Gucci. Though Hermes, known for its exclusive bags, has not been hit as hard by China's economic woes as other competitors, it has compensated for lower foot traffic in China by increasing average shopping basket values and focusing on sales of jewelry, leather goods, and ready-to-wear items for men and women. Ermenegildo Zegna, chairman and CEO of Italian luxury group Zegna, projected difficult times for the Chinese economy to continue at least until early 2025. The Double 11 shopping event has begun, and many local vendors expect either flat or modest sales growth at best. They also report that consumers remain deeply frustrated by China's economic challenges. Extended reading. Li Qiang urges experts to save the economy. Analysis. The CCP delays crisis eruption. Zheng Li, 46, told Reuters that she used to take Double 11 very seriously, eagerly buying clothes and household necessities, but not anymore. This year I can't find anything to spark my enthusiasm for shopping. Maybe I'll buy a jacket for my son, Schindler Group CEO. No sign of recovery in China. Heavy industry is also facing hard times with no immediate relief in sight. After announcing quarterly earnings on October 17th, Silvio Napoli, CEO of Swiss elevator and escalator manufacturer Schindler, said, "I want to emphasize that so far there is no sign of recovery in the economy and no indication of a turnaround." Earlier this month, Napoli returned from China and stated he saw no signs of the market bottoming out. China represented 15% of Schindler's revenue last year. He added that he does not view China's stimulus as the bazooka the economy needs, and the situation may become clearer when Schindler releases its full-year results in February next year. Trade tensions between China and the West persist, adding pressure on foreign businesses. More pessimistic assessments may arise, as only a few of the hundreds of companies in the StoxX 600 index and the US S&P 500 have reported their results so far. Moreover, multinational companies face additional challenges. In domestic markets, European automakers and white goods manufacturers like Electrolux are competing against cheaper Chinese products. With the U.S. election approaching, the U.S.-China trade dispute will persist regardless of the winner. Trump has stated that if he wins, he will impose a 60% import tariff on Chinese goods, which would heavily impact Chinese industries. The Biden administration's national security advisor reiterated the small courtyard and high wall strategy last week, preparing for potential shocks from China. This week, the European Union will impose tariffs of up to 35.3% on Chinese-made electric vehicles, escalating an ongoing trade dispute with Beijing, which has already retaliated. Xi and the CCP are scaring off another major player. The wave of divestment continues to spread. Well-known American consulting firm McKinsey & Company is restructuring its China business. In the past year or so, McKinsey has laid off a large number of employees in China. Analysts believe that this is related to the security risks faced by Western institutions operating in China. Moreover, Chinese companies such as Evergrande, which are its clients, have collapsed, causing the company to receive a sky-high fine. Coupled with the economic downturn in China, it is believed that the wave of divestment and layoffs will continue. The Wall Street Journal quoted insiders on Thursday, October 16th, that McKinsey, a leading American management consulting firm, is separating its China business from its global business to reduce the security risks faced when operating in China. The development is in line with McKinsey's strategic shift to reduce its reliance on government-affiliated clients. Earlier, the company reduced its clients related to the Chinese government and laid off about 500 people. The report pointed out that for international consulting firms operating in China, the field of government-affiliated clients is full of political and regulatory risks. At present, as the geopolitical environment becomes increasingly complex, multinational companies are increasingly strengthening strategic adjustments. Last year, McKinsey China chairman was very confident in the Chinese market at the Bund conference, believing that China would create another economic miracle. But unexpectedly, the Chinese economy declined, and McKinsey itself had to hastily leave the market in China. Ji Feng, a 1989 artist who once worked in a consulting company, told this station that the work of international consulting companies involves data investigations, which may lead to the CCP's national security law. Coupled with the Chinese economic recession, many foreign companies are gradually withdrawing from China or reducing their business in China. Ji Feng said, when consulting companies collect data, they may have violated the anti-espionage law and national security law. Now in mainland China, including Hong Kong, foreign companies, foreign enterprises, and foreigners have already felt that there is no security guarantee. Many foreign companies are leaving China. I used to do corporate consulting, and of course, I know that consulting is not easy now. They, McKinsey, used to mainly work with state-owned enterprises, listed companies, and large private joint stock companies. But now they are having a hard time. It is expected that the wave of foreign capital withdrawal will continue to spread. German expert on China issues Shi Ming believes that in addition to being frightened by the CCP's fabricated charges and hostage diplomacy, Chinese corporate clients of well-known Western consulting and auditing companies have been exposed one after another, causing them to be punished, which is not worth the loss. For example, PricewaterhouseCoopers, as the auditor of Evergrande, was fined more than 440 million yuan for audit errors. Shi Ming believes that the wave of foreign capital withdrawal will continue to spread. Shi Ming said, the main reason is that the Chinese government is now very vigilant and requires all kinds of information and information accuracy from international consulting companies in the Chinese market, saying that you are an indirect spy and accusing you of this. The second more important thing is that PricewaterhouseCoopers was fined because of the unreliability of Chinese listed companies, and its international reputation could not stand it, so McKinsey will not be the last one to lay off hundreds of employees. In general, the shrinking of high-end service industries is a trend. Since last year, the Chinese Communist Party authorities have arrested staff from Western consulting companies and due diligence companies on the grounds of espionage and leaking secrets. In March last year, The Chinese Communist Party authorities raided the Mintz Group in the United States and arrested 5 Chinese employees. In May, the Chinese National Security Department searched the offices of Capvision in various parts of China and accused the company of being an accomplice of overseas institutions. McKinsey officially entered China in 1993 and was one of the first global consulting companies to enter China. China Ping An Insurance and other companies are also McKinsey's clients. In June last year, McKinsey still had nearly 1,500 employees in Greater China. Over the past 2 years, the number of employees has been drastically reduced by about 1/3. Alarm bells are ringing: slow collapse or instant collapse. China's economy has no future. China's economy is in serious decline, and even previously released government data was unreliable. Now, the CCP can no longer hide the economic downturn. Data from the National Bureau of Statistics of China on October 27th showed that from January to September, profits of industrial enterprises above a designated size fell by 3.5% year-on-year, with state-owned enterprises experiencing a 6.5% drop. In September alone, profits for industrial enterprises in this category decreased by 27.1% year-on-year. Yu Weining, a statistician from the National Bureau of Statistics Industrial Department, explained that the ongoing decline in the Industrial Producer Price Index, PPI, in September has significantly pressured corporate revenue and profits. Additionally, the revenue growth rate for the first 9 months dropped by 0.3 percentage points compared to the first 8 months, and corporate costs rose faster than revenue, resulting in a decrease in gross profit. Since August, the high base of comparison has also created challenges for profit recovery, Yu added. Wang Guochen, assistant researcher at the First Institute of the Chinese Economic Research Institute, analyzed that China's economic prospects are down to 2 possibilities. One scenario is that China's economy continues its 3-year slowdown, with recent policies offering limited short-term effects, leading to inevitable stagnation. However, the greater concern is the potential for systemic risks, leaving China with 2 outcomes: a slow collapse or an immediate one. China's GDP growth rate for the first 3 quarters was 4.8%. According to long-term estimates, the difference between the CCP's official data and the actual situation has steadily grown, reaching double digits this year. After adjustments, the actual growth rate may be closer to 4.2%. Furthermore, 30 investment banks predicted an annual GDP growth rate averaging 4.8%. To reach the 5.0% target, the fourth quarter would need to achieve 5.2% growth. Since Xi Jinping came to power, fourth quarter GDP surpassing earlier quarters has only happened 3 times. Thus, meeting the annual target may be difficult. But because China adjusts the previous year's GDP at year-end, it is technically achievable, Wang explained. He outlined 7 major risks facing China's economy, including recession, finance, debt, and external threats. Among these, overcapacity is a primary concern for other nations. Although the government has invested in GDP growth, industrial inventory has risen by 20%, increasing insolvency risk. Deflation in China continues to escalate, and next year, food price instability and rising local public service costs may transform deflation into stagflation. Incomes are down, and people are facing rising prices, he noted. Zheng Zhengbing, a professor of finance at Taiwan's Yunlin University of Science and Technology, analyzed that China's medium and long-term economic outlook could follow either Japan's lost 30 years or the Soviet Union's collapse. Nobel Prize-winning economists Acemoglu, Johnson, Robinson, and Chinese economists Xu Chenggang and Wu Guoguang support this latter perspective. Zheng compared Deng Xiaoping's policies, which maintained an inclusive economic system, to Xi Jinping's approach, which is predatory both economically and politically. In the last century, no country has achieved sustainable development on a non-market or non-democratic path, he said. China's growth rate is steadily slowing, and Zheng predicts it may only stay between 2% and 5% over the next 2 to 3 years. Although China has recently increased patents and publications in areas like 5G, quantum mechanics, and space, bolstering its short-term competitiveness, its reliance on the Belt and Road Initiative in the Global South is only a temporary measure against immediate economic collapse amid export tensions with Europe and the U.S. The political leftward shift, rising geopolitical conflict risks, including North Korea and Iran's alignment within an axis of evil, and many adverse factors make a long-term decline of China's economy inevitable. Eventually, maintaining even 1% growth may become difficult. Why is the new wave of capital flight from China so massive? An analysis by The Economist and the Wall Street Journal reveals that the scale of recent capital flight from China has dwarfed the first wave of outflows in 2015 and 2016, which was initially triggered by the real estate downturn. In the year ending this June, as much as $254 billion is estimated to have left China illegally, according to the Wall Street Journal. This large-scale capital flight underscores the fact that those with the resources to move their funds out of the country are increasingly uncertain about the direction of China's economy. To evade government controls, people are resorting to both traditional and creative methods, such as shipping valuables overseas or overpaying for imported goods. Others have found new tactics, like exporting computer hard drives loaded with cryptocurrencies to other jurisdictions, where they exchange them for cash. China's real estate market collapse and uncertain economic outlook have prompted many to transfer funds abroad. Barclays estimates that China's property market crash has erased approximately $18 trillion in household wealth since 2021. In response, the Chinese government has introduced a series of large-scale economic stimulus measures. Analysts suggest that while these measures may boost growth in the short term, their effectiveness in driving a sustained recovery remains questionable. In the longer term, China faces additional challenges. On one hand, an aging and potentially shrinking labor force poses structural risks. On the other, China remains in conflict with the United States and the West on issues such as trade, security, and technology. Beijing has taken steps to prosecute certain fund transfer cases, hoping to deter others. Nevertheless, the Wall Street Journal quotes Rasmussen, a senior strategist at Exante Data, who notes that capital outflows continue, suggesting that investment opportunities in China remain scarce, with people willing to take risks for better returns. According to family office insiders managing Chinese assets, some business owners set up shell companies abroad in the names of family members. These foreign entities then acquire shares of their China-based businesses, effectively transforming them into Sino-foreign joint ventures. This setup enables them to transfer funds overseas in the form of dividends and other payments. Cryptocurrencies also offer an alternative avenue for fund transfer. Although China banned cryptocurrency trading in 2021, setting up crypto wallets remains legal. Chinese citizens can use RMB to purchase crypto assets with the help of intermediaries, which they can then exchange for US dollars overseas. Are Chinese banks rebelling? Don't listen to official claims. On the 24th, China expanded the scope of its real estate whitelist, announcing that loan amounts through projects are expected to exceed 4 trillion renminbi by year-end. However, some developers report a disconnect between government policies and bank actions. Banks are often unwilling to lend even if developers are included on the whitelist. According to China Business News, some developers noted that the whitelist process has significantly accelerated, with approvals in place, and now they only await funding. Additionally, some developers shared that, following recent real estate-related meetings, banks appeared more proactive than before. Despite instructions from Chinese Communist Party officials and some initial bank actions, many developers still struggle to secure loans. The process from whitelist inclusion to loan approval and disbursement faces several hurdles. The report cited insiders from financially strained developers who explained that while the government controls whitelist inclusion, banks ultimately decide whether to approve and release funds. Discrepancies often arise between government and bank assessments. Banks typically consider repayment risks, project quality, and asset sufficiency. If a project lacks these factors, even whitelist inclusion won't guarantee funding. Another source from a large developer noted that, although policy relaxations have increased whitelist inclusion chances, loan approvals still hinge on the project's quality and the company's financial stability. A real estate developer insider in East China commented that following the new policy, some previously ineligible projects might be reconsidered. However, most of the good projects were submitted in the first half of the year, and what's left are generally problematic. Xiao Yuanqi, deputy director of the China Financial Regulatory Bureau, recently stated that, as of the 16th, real estate projects on the whitelist had secured approved loans totaling 2.23 trillion yuan. The CCP's move could have severe consequences. The Wall Street Journal reported that China's semiconductor industry is currently facing overcapacity in memory chips, creating disruptions in the market. Data from investment firm Bernstein shows that Changshin Storage's bit density is only 55% of that of its more advanced competitors. Bit density measures storage capacity per unit area, and Changshin Storage's low yield means it produces fewer usable chips at a given capacity. Nonetheless, Chinese companies are aggressively acquiring chip manufacturing equipment to expand production. SEMI, the Global Semiconductor Industry Association, reported that China spent $24.73 billion on such equipment in the first half of this year, surpassing the combined spending of South Korea, Taiwan, North America, and Japan, $23.68 billion.